Greetings and welcome back to a market commentary video. This time, end of the third quarter, month of September. A lot of green on the screen, certainly much going on with the election and the Fed cutting rates. It seems inflation could be behind us in the eyes of the Fed, and now the focus is on the labor market, hence the half a point interest rate cut a week ago. So we'll unpack that, look at future equity returns, look at the labor market, look at household balance sheets, debt, all of those things. But all in all, a pretty good quarter. Let's get into the slides. Today is Wednesday, September 25th. All right. So this is a snapshot of assets that are important to our clients, and you can see a lot of positive numbers. So this is Bitcoin, gold, emerging markets, part of that rotation that I was talking about over the past few months, less about the S&P 500 and big tech. You're seeing some rotation into beaten down names, beaten down equity asset classes, and gold continues to be a freight train, up almost 30% on the year. And then bonds too have quietly put together a pretty solid last 12 months. You know, a lot of people were willing to write off bonds, saying they're no longer a part of a diversified portfolio because they broke down in 2022. You know, we've long said that the oldest form of finance, borrowing and lending, is not going away, and that higher yields could bode well for future returns for bonds, as bond returns tend to track very closely to current starting yields. So bonds are back, yields are back, investment income is back in fixed income, which is a good thing for savers and investors. Let's get into the labor market. So this basically gave the Fed a green light to cut rates. And remember, the Fed has a dual mandate. One is controlling prices, so managing inflation. The other is the labor market, maximizing employment. They want people to have jobs. And the labor market over the last, call it 9 months, has softened a bit. Even going back to the fourth quarter of 2022, it softened. But this isn't catastrophic. It's not yet a recession level. It might be a stretch to call it a flashing yellow light, but certainly the Fed's concerned enough to cut rates. So what we're looking at here, initial jobless claims. This is folks that are recently filing for jobless claims or unemployment. You can see this has steadily gone up in 2024. We got a bit of a breather the last 45 days. But again, this trend is a bit worrisome. Zooming out and looking at the 5-year pre-COVID average for continuing claims. So this is someone that has filed an initial claim and is continuing searching for a job. This line, again, has gone steadily up since the fourth quarter of 2022, but still below the 5-year average pre-COVID. And you can see this breather here in initial claims has shown up in continuing claims. So the Fed is watching this closely. Certainly a softening of the labor market could induce additional hikes and might even be a precursor to a recession. Consumer debt and borrowing capacity. So there's been a lot of media coverage on the levels of credit card debt in general at the household level. And I think some of it is misleading, but some of it does have merit as well. So what this is, it's basically a measure of how much credit households are using. And the higher this percentage, the more a household is borrowing as a percent of their available credit. So the first line here is a home equity line. And as this line goes up, that means people are borrowing against their house more. And you can see during the financial crisis, as outlined by this gray column, if you lost your job, turning to your house equity as a way to make ends meet before you got another job was certainly a reasonable play. And you can see this line moving up in response to the financial crisis. So the point of this is we're quite a bit below the pre-pandemic level for borrowing against one's house. However, the trend moving higher is not a good thing. So in finance, sometimes we're not so concerned with the absolute level, we're concerned with the rate of change. And certainly this is not a good trend. Looking at credit cards, again, we're below pre-pandemic averages of borrowing against your available credit on credit cards. But again, this trend is not headed in the right direction. And you can see during a recession, it makes sense that some folks would not only borrow against their house, but put more on their credit card to make ends meet. So This trend is something that we're watching, but the absolute levels are certainly not flashing red just yet and are well below pre-pandemic averages. Okay, so there's a lot going on here, but basically this tracks every Fed rate cutting cycle since 1984, and we're tracking performance prior to the rate cut, if there was a recession within the next year after the rate cut, and then future S&P performance for 1, 3, and 6 months, 1 year after the rate cut. Okay, so there's a couple takeaways here. One is obvious, one is maybe not so obvious. Post-rate cut, if there is a recession, future equity returns are lower. I don't think that's a shock. Rate cut, recession, future equity returns are lower. But in general, if we just get rate cuts, stocks tend to like that. Rate cut, and we don't get a recession, you can see the average performance post-rate cut is quite good 6 months and 1 year later, up about 14 to 18%. But there's another wrinkle here. If the market is up in the prior 3 months, and then we get a rate cut, we don't get a recession, future returns are quite good as well. And that would seem to be what's happening in September of 2024. The market was up about 3% prior to the cut. We just got a cut. If there's not a recession over the next year, history would suggest, based on every rate cutting cycle since 1984, future S&P returns could be quite good. Again, this isn't a promise of what's to come. This is simply what's happened. The other side of this is if the market is down prior 3 months to the rate cut, future returns are lower. But right now we're looking at this future return data set. So I guess it depends on if we get a recession versus no recession, and if the market is up or down 3 months prior to the rate cut, we know it was up. So this is a nice way to frame rate cutting cycles since 1984. Okay, so every quarter the Fed publishes their snapshot of U.S. household finances. And there's a lot of folks that are asking us, okay, I've parked a bunch of money in cash, the Fed's cutting rates, I'm going to get less in my money market fund. What should I do now? And I think that is a short-sighted decision because we've been writing about this for 18 months. What happens when folks clamor for cash like they did at the end of 22? So if you think back to 2022, very difficult year. A lot of folks were burned by the equity market, burned by the bond market, and they like the safety of cash. Okay? We caution that peak money market assets, folks clamoring for money market, was usually a precursor to better future equity returns. And when you look at the previous 20 to 30 years, that has held true. So think back to the tech bubble. When these lines are going up, that just means cash is a greater percentage of financial assets. And this is broken down by age, but I'm less concerned with that. Okay, so when you see these cycle peaks, when these lines are moving up, that's investors clamoring for cash. And it often happens after a market event. So think back to the tech bubble in 2000. Market way down, people clamoring for cash. Back to the financial crisis, market down 30+%, folks clamoring for cash. That's held true in 2022. You can see I've highlighted 2022. So when folks are clamoring for cash, again, that's usually a pretty good precursor to better future returns. It doesn't always hold, but it's held over the last 30 years. And then another head-scratching thing about this graph is folks under 40 are holding the most cash, which kind of runs counter to traditional finance. You know, the younger you are, the more fully invested, the more aggressively invested that you could be because you have time on your side to weather out the bumps along the way. And there's many theories on this. My personal theory is young people are very tech savvy. They're always on their phone. They're clicking buttons on the internet. They're accessing so much information, and a lot of the information out there is designed to make you feel worse. Doomsday media sells. And I think folks are getting caught up in the algorithm and getting down rabbit holes, and it's quite frankly paralyzing them to do what they probably know is the right thing, but they can't get past what could happen next, what bad thing could happen next. That's my personal theory. I'm not saying that's Pure Portfolio's viewpoint, but that's my own personal theory based on my social circle, the folks that I talk to. So that's what I'm going with. But the takeaway here is when folks are rushing into cash, it's usually a decent time to do the opposite of that and perhaps stay invested, or if you do have cash, to put it to work in more risky assets. Okay, I wrote a blog about this as well a few weeks back. And what this is, it's from the same Fed report, and we're basically measuring equities as a percentage of financial assets. And again, this is by age, but there's a more important takeaway. So again, I've highlighted a few of these peaks. So when these lines are going up, that means U.S. households own a greater percentage of stocks as a percent of their financial assets, a greater allocation to stocks as a percent of their financial assets. And it's the opposite of the cash. So when these numbers are going up, that's often a precursor to lower future returns or a market pullback. So this is the tech bubble, and this is essentially people just performance chasing. Tech stocks have done well. I'm going to shovel money into tech stocks. Back in the financial crisis, stocks had done well. I'm going to shovel money into stocks. And you can see these following crashes are folks panic selling, right? So their equity values are down, but they're also panic selling in response to the market crashing. So many of these peaks in equity ownership percentage have been a canary in a coal mine for perhaps a difficult market environment around the corner. And you can see where we're currently at today. So this was 2021, market crashed in 2022. So I'm not saying this is a precursor to a market crash, but it's something to pay attention to. And this has been a really good data point. Some people say this is the best predictor of future stock returns, how euphoric U.S. households are in their allocation to equities. And again, this tells another interesting tale by age, where older folks actually own more in equities than younger folks do. So this dark blue line is folks over 70. This gray line is folks under 40. And again, my thesis on the younger folks consuming a bunch of information, consuming doomsday information, still holds here. This is something that we see a lot with prospective clients. They're taking more risk than they set out to. A lot of that has to do with it's been a pretty good run for U.S. equities the last 10 years. Many folks are piling into the best performing equity asset classes. Their balances have grown over time. You know, they might say to themselves, why would I sell these stocks when they've really worked? And there's certainly nothing wrong with that. However, this is a great time to understand how much risk that you're taking. The latest bout of volatility that we got in July and August were the first opportunity in 2024 for investors to kick the tires and see how their portfolio acted in a period where the S&P was down about 9 to 10% in a few week stretch. So I encourage people to check out that video. Perhaps we can link it, but I go through very simple steps that you can take to see how much risk that you're taking. Because despite what people think, the time to dial in your portfolio, the time to see how much risk you're taking is right now. It's not after the market is down by 20%. You go in and make a bunch of emotional changes. So good investing starts today. Again, many investors are in tune with how they're doing. I'm up 10% on the year. I'm up 15% of the year. Almost nobody can tell you how much risk that you're taking. And it's probably the biggest mistake that I see for the managed portfolios that we inherit from other advisors. So that's it for the month of September. I hope you enjoyed this. If you have any feedback or questions or want to know how Pure Portfolio manages client portfolios, feel free to shoot us a note at insight@pureportfolios.com. If you're on YouTube, give us a like, give us a sub. It really helps us out. Thanks. We'll see you next month.